Great, thank you, Ray, and good morning, everyone. Again, when I saw the hands go up earlier on the preference for Spanish, I apologize. I had a fair amount of Spanish growing up, but there's no way I can give a Fintech presentation in Spanish, so I'll try and go a little bit slower than I normally do as a fast-talking New Yorker. So the subject here is the worldwide transformation of small business lending. I'm just going to spend a couple minutes talking about OnDeck and the company we've built. We are the leading online small business lender in the U.S. As Ray mentioned, we now are powering a program for JP Morgan Chase, as well as another major bank we're going to announce later this year, and a pipeline of banks behind that. But what I'm really excited to speak about today is really the global fintech adoption. I think some of the technologies and trends we've developed over the last decade here in the United States are now really spreading globally. Others are innovating on their own globally, and it's really starting to hit a new level of scale and excitement and investment that makes it a very promising next decade of fintech and adoption. And then finally, we'll talk specifically about the Latin American and Caribbean region and why we think this could be such a home run set of technologies to deploy there. So very quickly, introduction to OnDeck. Our mission is very simple. We are here to help small businesses succeed. What we've learned over 10 years is that every small business owner defines success differently. Many define it in terms of growth. How can I grow my small business? Many define it in terms of stability. They've built something over decades and they want to preserve it and pass it on to future generations. Others define success at being the best in their field, the best restaurant, the best florist, the best doctor or dentist. And so our mission at OnDeck is to create innovative lending experiences and financial products to help small businesses succeed. Our vision is to be the first choice lending partner for underserved small businesses. Small businesses globally are not well served. They kind of fall into this in-between category between commercial enterprises, which banks actually serve reasonably well, and consumers, which many incumbent financial institutions serve well also. But a small business has not the scale of a larger enterprise, which makes it worth a bank's time to spend time on to make a loan, nor do they have the large end-user target market of consumers. And so that's why they're often caught out in the cold when it comes to accessing financial services. So the company we've built is the leading online small business lending platform. We are actually just now crossing over $10 billion deployed lifetime to date to small businesses through our platform. And we are global in the sense that we're in 3 countries, the United States, Canada, and Australia. But clearly the challenge of small businesses accessing capital is universal. And we believe that there are probably 50 countries around the world where a model similar to OnDeck's could make an absolute lot of sense. We've served over 100,000 small businesses now, and we've developed what we call the OnDeck score. So just like here in the US, you have the FICO score that describes your creditworthiness as a consumer, we've actually created a scoring model now over the $10 billion of lending called the OnDeck score that focuses on your creditworthiness as a small business with a very, very different approach than a traditional lender. Once a customer tries the online loan process versus going to a traditional bank, they never want to go back to doing it the old way. So our net promoter scores, which is a key measure of customer satisfaction, are actually very, very high. They're right up there with Apple and Amazon and much higher than traditional net promoter scores in financial services. We do have some leading partnerships, which I'll talk about in a little bit. And the other thing I think that's important about our model is that we're profitable. And it took a decade to build enough scale in our business to offset the heavy fixed investment we made in technology and systems and credit model development. But now we're at a scale where this business model is profitable. And so what I'm excited about now is you have fintechs in a number of different categories hitting scale. And when they hit scale, they become profitable, and that virtuous cycle of reinvestment can begin. And really, I think, portends very well for the sector over the coming years. So a little bit about the OnDeck score and what makes it different. When we started the business, most banks to serve small business loans would actually focus on the personal score, the credit score, the FICO score of that small business owner to make their loan decision. And the problem with that is that you have false positives and false negatives. So let's say Noah, me, I own a restaurant. I might be very, very good at paying my mortgage, but terrible at running my restaurant. I'm a lousy cook, I'm a bad manager, no one shows up to eat. And if you just look at my personal credit score, you're going to miss that. Similarly, when I started my restaurant, I probably used personal credit to get it off the ground. I probably borrowed on my credit cards, I borrowed from friends and family, and just when I have a thriving restaurant that's generating cash flow, actually my personal credit score doesn't reflect the strength of my restaurant and how well it's doing, and actually I look over-levered relative to the average consumer, so there's false negatives as well. So the OnDeck's score looks at the business first to make a credit decision. That was sort of one of the major insights we had when we started the business. It's very much proven true over the last 10 years. Another major insight that I wanted to reflect on as well is that we learned that no single data source is enough to make a good loan decision. And actually, it's a multitude of data sources that you need to look at. We actually look at over 100 different data sources. Not all of them are equally weighted, but when we make that OnDeck's score decision, we actually collect a lot of data on small businesses now to make that loan decision. And we found that by having a blend of different types of data, cash flow data, credit data, some personal data, some business data, firmographic, industry, location, all of these things working together to make a better credit decision. The final thing, and I think it's particularly relevant for the Latin American region, is the issue of data completeness. So when you go to a traditional bank, the bank will look you up in the US in a credit bureau called Dun & Bradstreet. Have people heard of Dun & Bradstreet? Is that familiar? Fairly a 100-year-old company. And if you're not in Dun & Bradstreet, guess what? You are going to have a very hard time applying and obtaining a loan from that bank. And so what we learned is that you have to actually be able to make decisions that are pretty good, even if all the data is not available. And I think that's another strength of the OnDeck's score. If all of the data sources we would like to have are available, we make a great decision and a fairly aggressive loan offer for our customers. But what we can also do is if a data source is missing or the data is incomplete, the score doesn't come back and say, I can't make a decision. We actually will make a pretty good decision, maybe a less aggressive loan offer. And that kind of technology, that graceful degrading of your ability to make a credit decision is very different than traditional banks, and I think it's essential to serving small businesses in emerging markets. Small business lending leads to very positive economic impact. So the customer profile for us, almost $700,000 in annual revenue, and what really surprised us is that our average customer at OnDeck was 8 years in business. And so when we started the company, we thought our average customer might be 2 or 3 years in business. Because surely, when you've run a business successfully for 8 years, your bank is going to lend to you in the United States. That turned out to not be the case. Our customer's big issue is that they're small. And banks have such high fixed costs to make small business loans, and they only want to borrow, say, $50,000, $100,000. That is not a cost-effective loan for the bank to make. That is why this sector is so clearly underserved. Once you do start making loans into the sector, we did a study with 5 online lenders, including OnDeck. We found that after funding $10 billion collectively to 180,000 small businesses in the last 3 years, we generated $23 billion for the borrowers, $38 billion of local economic impact. So you think about that, it's pretty impressive. You put $1 of loan out, you actually generate $3.8 of economic impact in the supply chain, and that created literally hundreds of thousands of jobs. So getting this right is not just an interesting business proposition, it's an important economic engine to lead to growth in economies around the world. Our first $10 billion has been quite a journey, and I think what's fascinating is in the US, we really went through 4 stages of the market, which are shown in the middle of the slide there. Low awareness, what are you doing? This makes no sense. That was the skepticism phase that we got to right after the global financial crisis, and understandably so. But then what we saw was once a few models started to prove out, we saw a stampede. Tons of investment flowing into the sector from venture capitalists, from private equity firms, from family offices, hedge funds, credit funds. And so that stampede led to an avalanche of companies entering online small business lending. And in the last sort of 18 to 24 months, we've seen a shakeout. It's very evolutionary. It's survival of the fittest. Some of these models are going to gain scale and continue to grow. Some of the players who entered this market didn't quite have the formula right and have now either exited, been sold, or shut down. And what's fascinating is in Canada and in Australia, we are now watching these markets go through the same phases as the US did, just lagged by about 5 years. So that's a little bit about OnDeck. Let's talk now about global fintech adoption, which is really exciting in terms of where it is right now. So, in just the last couple years, we've reached the early majority, getting towards the center of the bell curve now on fintech adoption. So we've gone from 16% in 2015 to 33% in 2017. And what's really cool is that actually in emerging markets like Brazil and Mexico, we see adoption as high as 46%. So you're seeing this trend of in emerging markets, almost a leapfrogging of traditional modes of financial services, going right to fintech as smartphone adoption goes up, as digital banking goes up. And so that acceleration is now happening globally. You have some very cool technologies that are underpinning this wave of innovation. And so machine learning and artificial intelligence plays very strongly in our business as we develop new credit models. You have the blockchain and Bitcoin and crypto, which is going to revolutionize sort of money transfer and a lot of different ways to store value. And then even something as basic as cloud computing, which we are now kind of all getting used to, is huge because it lowers the startup cost for a new fintech venture. 20 years ago or 15 years ago, even in the early days of OnDeck, we built physical data centers. I still have 2 physical data centers at OnDeck, but everything I've done in the last couple of years is in the cloud. But a company starting today would not be encumbered by those physical data centers. They can start directly in the cloud and lower their startup costs by a factor of 10. So with all these new technologies, what's happening? We're attracting capital to the space. And this is a mind-blowing skyrocketing of investment into fintech globally. So we are now well over $20 billion a year of investment, venture capital investment into fintech around the world. And remember that venture capital is an asset class that seeks a very high level, a very high internal rate of return. So if you do the math on this, you're talking about an internal rate of return, call it 20% or higher. At $20 billion a year, within just 3 or 4 years, that $20 billion of investment should turn into about $40 billion of market value. So $40 billion worth of companies are essentially being seeded every year now with venture capital investment into fintech. That's a very, very powerful economic force. And finally, on the regulatory side, we saw some presentations on this yesterday. Regulators are now aware of fintech, and they're actually stepping up and realizing how important it can be for economic development and starting to create regulatory sandboxes, frameworks for fintech companies to apply for licenses and charters. That's a very important piece of the puzzle. In our category, online small business lending, we see a lot of very similar models to OnDeck cropping up around the world. People realize this is a global problem. Actually, many years ago, we had small business owners go apply for loans in a variety of countries around the world and document their experiences. And in Australia, one of the markets that we're in, it took a small business owner 44 days to get that loan. An amazing amount of time. And so what we've done at OnDeck is we've taken that time down to minutes for smaller loans and hours for larger loans of up to $500,000. So just think about that friction of 44 days for one process and minutes or hours for another process. It radically reduces the energy required on the part of a business owner to get the capital they need to grow their business. So what we see now is that all around the world, very similar models are taking hold. There are probably 20 to 25 very similar companies to OnDeck around the world doing online lending and reducing that friction in their markets. And so, of course, traditional banks are going to respond. And when you respond, you really only have 3 choices. You can build, you can buy, and you can partner. And what we're seeing is banks starting to do all 3. So we're past that skepticism stage, I think, in the banking sector with regards to fintech. They know that lending is moving online. It's inevitable. Any category that can move online over time will. And we're seeing it in e-commerce. We're seeing it in ride sharing. And money is the ultimate digital product. So it makes total sense that lending will move completely online all around the world in the next 5 or 10 years. It's a once-in-a-generation transition, and banks have to figure out how they're going to play it. So on the building side, Chase recently announced a digital-only bank. HSBC just launched a cross-platform banking app to their customers. On the buy side, you see Goldman Sachs moving aggressively into the category with Marcus here in the US. They acquired a company called Clarity Money to help people manage their personal finances. KeyBank recently acquired a small platform called Bolster to help them with their online small business lending. And then on the partnership side, you see really a very interesting set of activity. We've partnered with Chase several years ago now in what I think was a groundbreaking partnership for the industry. But in other asset classes as well, online consumer lending, a company called Avant partnered with Banco Popular to launch a product called eLoan here in the US, and that happened relatively recently, and we'll see more of these partnerships over time. And so our belief at OnDeck is that partnering makes sense for both the fintechs and the banks. And I think in the original days of fintech in the US, it was always painted as a war that the fintechs were coming and the banks were going to fight back. And I think actually 10 years later, we realize it's going to be much more of a partnership type model that dominates. And why? Because each side has their own strengths. The banks have customers. They actually have data, although they have trouble using it. They have access to capital that we don't match. We don't take deposits, at least today. And so there's some natural advantages in cost of fund, the quality of applicants, and the finding of applicants that banks will always have. But of course, there are advantages the fintechs bring. We are nimbler. We bring innovation. We can use alternative data to create new types of credit models. We're actually more agile at risk-based pricing. And we're more agile at servicing existing customers and maintaining that relationship over time without a physical branch footprint. So we think partnering makes a lot of sense for both banks and fintechs. And so how it works in our partnership with Chase, we call this OnDeck as a service. So Chase is doing the marketing, Chase is balance sheeting the loans on their books, and we are doing everything in between. So the technology, the underwriting, actually the telephone sales and customer service also runs through an OnDeck team. And then the loan servicing and even the early stage collections are done by OnDeck. And so what we've been able to do is by integrating with the Chase platform, we actually can create a better experience in some cases than OnDeck can create on their own. Why? Because Chase already knows their customers. OnDeck is in the business of lending money to total strangers over the internet. So we have to do a lot more validation than Chase does when they're lending to an existing customer who has worked with Chase for many years, so we can make the process faster. We can also integrate with data that's hard for OnDeck to get on their own. So with Chase, we can actually take 2 years of deposit data and integrate that very seamlessly with no effort by the customer into our loan decision. And so additional data, lower friction, makes the process very, very fast. And in Chase, we're able to give a loan in 6 clicks online. And when you listen to the customer calls, sometimes they call in afterwards because they can't believe the process happened as quickly as it did. And so it's a very exciting thing to see. And now we're in the process of rolling out similar partnerships with other banks and licensing this technology more broadly. So that's a great example about how banks and fintechs are working together. So let's talk now about the opportunity in the Latin American and Caribbean region. So this is a great quote, I think, from the Inter-American Development Bank. Financial markets represent the biggest barrier to growth in most Latin America and Caribbean countries, and we certainly agree. So there's obstacles and there's opportunities in Latin America. Let's talk about the obstacles first. First, there's a high cost of borrowing. It's a very inefficient market structurally, and we'll talk about base rates in a second. Second, you have limited access to financial services still. And we'll look at penetration of, bank account penetration in the US versus some of the markets in Latin America. The good news is it's all trending up. It's all going in the right direction, but that it's not quite at that tipping point yet where the majority of folks have access. Then you have financial infrastructure and credit reporting. So if you think about what a business like OnDeck or any online lender needs to enter a market, you need a reliable way to move money. You need every endpoint, every small business or every consumer to have a bank account that you can move money into. And then you also need reliable data on which to lend. And so credit bureau infrastructure, data available about small business owners or consumers, the absence or presence of that data can be the threshold you need to figure out if you can make your business model work. And then clearly you have some macro and currency volatility that you have to solve for. So the opportunities we see are that technology can absolutely update these legacy branch-based, paper-based processes for making loans. This unbanked population is just going to shrink in the next 5 or 10 years. And so I think that trend is already happening regardless of whether there's online lending in these markets. On the data side, more and more data will become available electronically about both small businesses and consumers. And then you have regulatory, largely support. There's support by regulators to make these markets more competitive and to open up capital access to a broader swath of the population. So in the side of an obstacle, you have the base rate issue, higher borrowing costs in Latin America. And so that's an obstacle in some ways. But on the flip side, it's actually an opportunity for fintechs. Most of us lived with much higher borrowing costs than banks as we built our businesses. So actually, these conditions are not foreign to a fintech and actually reduce the spread between what a bank loan might cost in a country like Brazil and the type of pricing a fintech like OnDeck might be able to achieve. So that's sort of a very interesting potential obstacle that I think fintech can overcome. Then you have the access to financial services. What percent of the population in these markets has a bank account? And what you see is that in the LAC region, this is improving about 3% annually, and some markets are ahead of the average. So Brazil here is now cresting at 70%. The US is now in the 90s, but the great thing here is that, again, the trend has always been up and to the right. It will continue to be up and to the right. And I would argue in Brazil, at 70%, probably going to 80 or 90 in the next couple years. That really is the final gap you need to close to deploy online loans and online financial services. On the credit reporting side, really, really interesting. There's an inverse relationship between the number of banks in the country and the quality of the credit bureau data. And if you think about it, it's a classic sort of competitive power dynamic. In the US, you have 6,000 banks, and so no single bank has as much market power. Therefore, they all need a central repository of data to make better decisions, and the credit bureaus have a fair amount of power. They don't have that much trouble getting data from banks, and the banks buy credit bureau data in droves. In Australia, another market we're in, which actually is more like, let's say, a market like Brazil, there's only 4 major banks that control 85–90% of the market. And so what happens is no single bank needs a credit bureau because they all have such market share. Their internal data is often enough to make a good lending decision, and they don't want to tell the other banks who they're lending to. So what you see in Australia is the quality of the small business credit bureau data is 20 years behind the data quality of the US. They are just now starting to implement what they call positive bureau reporting for consumers. And small businesses still have not been figured out. So very, very interesting dynamic there. That's something that we're going to have to sort of solve. And that's actually one of the hardest things, I think, to do here, is to develop a reliable data infrastructure to collect data about all these businesses and consumers and make a good lending decision. On the positive side, though, the growth of digital banking, I think, signals an opportunity for financial inclusion. Clearly, smartphone adoption is a huge part of this. And the venture capital focus on Latin America and Caribbean has only increased as well. So you see $1 billion invested in 2017, and really blue chip global investors making big bets. Yesterday there was a gentleman from QED on one of the panels. They're one of the best investors in fintech here in America. They now have an entire segment focused on Latin America. They've invested in companies like Nubank in Brazil, which look like they're going to be absolutely huge institutions. So global investors are taking this very seriously, and that level of investment only portends good things, because now, with the digital banking going up and the venture capital investment going up, you have an explosion of company formation. Not all the companies on this slide will be successful, and you probably look at the same number of companies in 3 or 4 years, and half of them might be off the list. That's okay. Because what it means is that some other companies are going to figure out their models, figure out this market, and start to really scale up, and that's when consumers and small businesses will start to benefit. From a regulatory perspective, you've actually seen some really nice advancement in a number of markets in fintech regulation this year. So in Mexico, there's an approved bill now to regulate fintech with open banking, crowdfunding, and crypto, all encompassed by this bill. In Brazil, the central bank released rules to authorize peer-to-peer lending. And then here in the US, there was a gentleman from the OCC here yesterday. They've created actually a fintech bank charter. So actually a process that gives you a national banking charter if you're a fintech, and that's a very, very interesting and important development for the sector. So with the regulation in place, and I think the digital adoption in place, you now have a situation where globally, these models are taking off. That's sort of unquestionable at this point. And in Latin America and Caribbean, I think it's only in the next couple years you will really start to see that inflection point where some of these early fintechs that are getting funded now will start to hit scale and breakaway scale and start to take significant market share. And so with that, thank you guys very much for your time. I appreciate it.